If you're someone who's wanting to buy a car in 2025, or you're someone who has already purchased a car this year, then this is a video that you will not want to miss. Last week, we got some news out of Washington, D.C., and I think that we can all breathe a sigh of relief because no, this is not a tariff policy update. Last week, H.R. 1, or otherwise known as the One Big Beautiful Act,
with the bill, the one big beautiful bill, and it is a big beautiful bill.
well, it passed the House. But this bill is still far from set in stone because it does have to pass the Senate and then it has to be signed into law by Donald Trump, which shouldn't be a difficult feat given the fact that he has been outspokenly supportive of this bill. The H.R. 1 bill has a pretty heavy focus on things like taxes and deductions, and as a result, if this bill was to move forward and be passed, there could be some pretty big tax changes for the average American. And the first change that I want to talk about is auto loan interest deductions. Within the bill is a tax deduction on the first $10,000 of auto loan interest for U.S.-made vehicles. Now let's talk about what this is, what it isn't, and what this means for the average American. But before we dive into that, I do want to offer a bit of a caveat that I am not an accountant. I do not rely on my own accounting knowledge to do my own taxes, and I have a professional accountant that I consult with all things taxes. So I do not think that you should use this video as the end-all be-all for all things taxes and deductions. Instead, what I think it can do is put some of the ideas into your head so that you can ask somebody much smarter than myself. Now, according to a quote from U.S. lawmakers, the average American family will be able to fully deduct auto loan interest for American cars. And according to the bill, as for auto finance, the bill will permit consumers during the 2025 to 2028 tax years to deduct up to $10,000 in interest per year on consumer vehicle auto loans. Vehicles that are salvaged or are purchased for scrap or parts are not going to be eligible for this deduction. Additionally, lease payments, title loans, and fleet and commercial vehicle loans will also not be eligible. You also have to be under a certain income threshold in order to qualify, and for every $1,000 a single taxpayer earns over $100,000 or over $200,000 for couples filing jointly, the amount you're able to deduct in interest would fall by $200. So for example, if you're someone who makes $110,000 per year, you're filing as a single individual, that means that the amount that you can deduct from your taxes due to auto loan interest would go down by $2,000. So instead of being able to deduct the full 10 grand, you would be able to deduct a max of 8 grand. And essentially anybody who's earning over $150,000 wouldn't be able to deduct anything. Now, to give you a picture as to what this deduction would look like for the average American purchasing the average new car, here are some figures courtesy of Automotive News. The average new car loan is about $41,444 over a 69.1 month term with a 7.1% interest rate. Based on these figures, the average car buyer would pay $2,748.45 in interest the first year. Given that interest would decrease as the amount owed decreases, this borrower would pay in total $8,202.52 in the years of 2025 to 2028, which is the years proposed in this deduction period. And according to experts, deducting that $2,748.45 in interest in that first year would roughly work out to $274.85 in tax savings using the lowest U.S. tax rate of 10%, and it would equate to $604.66 in tax savings at the 22% tax rate, the rate assessed in the bill's income benchmark of $100,000. This is saying that roughly the average American, depending on where they live, would be able to deduct anywhere between about $275 to $604. This would be on a per year basis, of course, fluctuating depending on where the person lives, their tax rate, how much they make, as well as the interest rate that they paid. And because of how the bill is structured, Americans would be able to take advantage of this tax deduction regardless of how they classify their vehicles. It is important to note that this is not a credit, it is a deduction. So unlike something like the child tax credit where you actually get money back, that's not going to be the case here. Additionally, in order to qualify for this deduction, you must buy a car with final assembly in the United States, and the deduction would work with cars, RVs, and motorcycles. Now, there are aspects of this proposal that I don't love, but there are obviously portions of it that I like. One of my qualms with this bill is the fact that I think that this doesn't really solve any of the problems that we have in the car market. Sure, it does offer some reprieve on interest payments, but I worry that the people who would be most affected by this with the highest interest payments may not even know that this is a thing, and thus they may not know to take advantage of it when tax time comes. Additionally, I think in some ways this incentivizes people to take up debt, which is something that I'm obviously not a big fan of. I don't think that we should be incentivizing Americans to take on more debt. Instead, I think that we should be figuring out ways to make living more affordable, thus allowing for Americans to take out less debt. But on the flip side, as a business owner who buys a ton of vehicles and thus takes advantage of a ton of tax deductions associated with car purchases, I have learned a ton about this world over the last 8 years, and I think that the advantages that business owners have when it comes to deductions is very unfair compared to what the average American has access to. And so the fact that there is finally a really good deduction for a non-business owner American is something that I am absolutely for. Now, like most tax laws, if this was to go into effect, say, in June of 2025, even if you were to purchase a vehicle before June of 2025, you can still take advantage of these tax deductions. And so this is something that you will want to keep in mind if you are someone who is wanting to purchase a car. Now is the dark side of this bill, at least in the context of the car market, and that is that if this bill passes, it looks as though the EV tax credit could go away. Which truthfully, if you are an EV buyer, you are much better off taking advantage of the EV tax credit versus this $10,000 interest deduction because you will receive more through the EV tax credit. Now with this new bill, the EV tax credit as well as many clean energy tax incentives would go away after 2025. That means no more EV tax credit of $7,500 or $4,000. Now, as you guys know, the EV tax credit is a Biden-era policy, and it's one that was a pretty big deal whenever it was released. It's also one that came with a lot of confusion, but it feels as though the kinks of it have finally been worked out. But truthfully, it's not a surprise at all that it looks like this is going to be getting the axe because Donald Trump even campaigned on the idea that the EV tax credit would potentially go away. So it makes sense that they are looking to do this in this bill. Now, like anything in Washington, a lot can happen between now and when the bill is signed into law, but what I do think that this does mean is if you are someone who's looking to buy an EV and you want the credit, I'd buy this year. The reality is, whether it's through HR 1 or through a different bill, we are only a couple of months into Donald Trump's presidency, and he has said that he wants to get rid of the EV tax credit. So if it's not now, it's going to be later. And so if you are someone who is wanting to buy an electric vehicle, especially if you're wanting to buy one with the electric vehicle tax credit in mind, I would look at buying much sooner than later. Now, the good news is that if this bill does get signed into law, it's not like the EV tax credit will go away in an instant. It's going to be expiring at the end of the year if this bill passes. And there has been discussions about certain types of EV tax credit carrying into 2026, but that would be based off of specific make and model as well as production numbers. Now, I mentioned that if you are someone who's wanting to buy an electric vehicle and you want to take advantage of this credit, you should buy sooner than later. But on the flip side, whenever it comes to this interest deduction, I don't think that there's a huge rush in running out and buying a car in order to take advantage of this because this is a bill that would be intact from 2025 to 2028. So if you wanted to take full advantage of the interest deductions, I probably would encourage you to buy in 2025. However, I would probably wait until this bill gets passed before you make any decisions based off of the tax deduction. And truthfully, I think that the tax deduction really isn't that big for you to make purchases based off of it. Instead, I think it's something you should keep in mind if you are someone who is looking to buy a car anyways. So there you guys have it, some of the most up-to-date information out of Washington, the EV tax credit, as well as this interest deduction plan based off of HR 1. I will keep you guys updated as these bills are passed or they look to be passed or we get more information. So make sure to stay tuned. Like always, you guys, if you have any questions, comments, if you have anything to add, I would love to hear it. So make sure to leave a comment down below. And while you guys are at it, make sure to hit the like button, hit that subscribe button, and hit the notification bell, and I will see you guys in the next video.